to regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. That was why the Reserve Bank of India was established in 1935, and that still remains its main purpose. Its first governor was Osborne Smith, and it was not until 1943 that an Indian took charge as governor. As the fledgling central bank came to grips with a war-torn economy, the Public Debt Act of 1944 and the Banking Companies Act of 1949 were passed, increasing RBI's powers from a monetary regulator to a banking regulator and money manager of the government. Through the 50s, the RBI came to align itself with India's development needs. An important policy change in this period was the system of note issue. The proportional reserve system followed until then required the Reserve Bank to maintain 40% gold and forex reserves. In 1950, the RBI changed the basis of note issue to a minimum reserve system so as to expand the currency to meet the requirements of a growing economy. This was the earliest version of liquidity support to development. The early 60s was a period of institution building. Bank deposit insurance was made mandatory. The RBI introduced cash reserve ratio or CRR for the first time, and statutory liquidity ratio was mandated at 25%. During this period, IDBI was set up as a subsidiary of RBI to channel funds to industry. The late 60s to mid-80s was the era of social control. In 1969, major banks were nationalized. Quantitative restrictions on credit were placed. In January of 1974, the Foreign Exchange Regulation Act came into force to conserve foreign exchange, which was then becoming a scarce resource. The 70s saw the rise of OPEC and the surge in oil prices. The RBI was preoccupied with soaring inflation and dwindling foreign exchange. It was forced to raise policy rates steeply and keep a strict watch on foreign exchange spending. In 1985, the Sukhomoy Chakrabarti Committee was set up to review the monetary system, and it recommended far-reaching changes. As a result, 182-day T-bills were introduced. By 1988, certificates of deposit and commercial paper were introduced in India. The 90s began with India on the verge of defaulting on an IMF loan and having to ship gold to prevent default. The crisis gave birth to rapid economic liberalization. On the external front, the rupee was devalued in two stages. On the banking front, the Narasimham Committee report suggested far-reaching changes in Indian banks, including cutting CRR and SLR. In 1993 came guidelines to set up private sector banks. A year later, the rupee became convertible on the current account. The same year, lending and deposit rates of banks were deregulated. 1997 saw the first move to control deficit and create an interest rate market. The system of ad hoc treasury bills was replaced with the Ways and Means advances, ending automatic monetization of fiscal deficits. In the November of 1997, Bimal Jalan was appointed governor in the midst of the Asian currency crisis. Though the country was largely unhurt by the currency crisis that roiled the region, CRR and repo rates had to be raised to stem the outflow of foreign capital. Fixed-rate repos and G-Secs were introduced for liquidity management. By 1999, it was reforms as usual. The RBI introduced interest rate swaps and forward rate agreements. The new millennium saw RBI take steps to boost growth, but by 2003, the central bank had to tackle problems of plenty. Growth came in all its ferocity. The RBI had to lean against the wind and prepare banks and the economy for the downsides of rapid growth and hot money. Unmoved by fancy derivatives, RBI put down what is now accepted as world-class rules for securitization. It also put in prudential measures to weigh down lending to fast-moving sectors like real estate, capital markets, and personal loans. The RBI also created innovative instruments like the Market Stabilization Scheme or the MSS to tackle large capital flows.
There is some continuing pressure on inflation.
Come September 2008, the worldwide asset party ended and financial markets went into a seizure. RBI moved full throttle to tackle the liquidity evaporation with rate cuts, liquidity support, and easier loan structuring. In just 2 quarters, India has emerged as one of the fastest growing economies in the world. In its Platinum Jubilee year, CNBC TV 18 salutes the RBI for being one of the few central banks that can boast of an average 7% inflation for over 6 decades and a current account deficit below 3% throughout this period. In the years to come, RBI is sure to assume a larger role in a world that needs its experience and its foresight.